right, welcome to Your Time, Your Money, the show where your time is just as valuable as your money, and we know that. Thank you so much for tuning in today. Good to see you, Matt.
Good to see you. I brought my extra big notepad, and in anyone else's hands it would look normal, but in my hands it looks like a little scribble pad. But
yeah, we actually brought that in because I thought it was funny.
If I give it to Mark, pick up yours. If I give it to Mark, here's what happens when I give it to another person, right? Look at how big it is, and it's somebody.
Amazing what a camera can do.
It's all camera angle. The camera adds a couple 100 pounds, so hopefully not for me, the angle that we're at here.
Oh, excellent. Hey, I'm excited to be here today. We're here in February, and for those of you who don't know, February is Insure a Loved One Month. Yeah. So we're going to run with that theme today. We have a great theme, and that's the basics of insurance on children. I think that's a very powerful thing to do that people don't realize.
It's an underutilized area in a lot of people's portfolios, but hopefully we can give some people some information today, and they could start doing stuff for their kids.
Yeah. So let's get started. It's your time.
Your money.
Great.
I'll flip the burst session one today.
So let's delve into it, right? I mean, getting insurance on a child. Right, especially as a newborn, for instance, or a parent, there's sometimes some negative connotations with that. Right? People, well, why would I insure my child? I don't want my child to die. Well, that's true. You don't want to die, right? But sometimes the best thing you can do is getting insurance on a child as a newborn.
Well, I mean, I think that's a really great first step, but I want to make sure we debunk all the myths that are out there from what the baby boomer generation has experienced, and even our generation, right? A lot of our generation has Gerber policies from when they were kids, right? And they're like $10,000, right? And
not
like $5,000, right?
$500
of death benefit, and then the cash value maybe is a couple $1,000. So I got to make sure that, like, for the people out there listening, they might have something on themselves. And like when someone says, "Oh, I have insurance from when I was a kid," I'm thinking like, "Oh, great, you've really got some equity built up." And then I look at it and it's like the Gerber policy with like $2,000 of death benefit, right?
And people have to understand, no matter what the product is, whether it's insurance or mutual funds or whatever, products evolve over the years, right? There's products that are out now that were never thought of 10, 15, 20 years ago, right?
Didn't even exist.
Because companies want to be competitive. So they're going to offer a product and put their twist on it, put a different bell or whistle on it that's going to, make that product sell a little bit better. Yep. So, when you talk juvenile policies, we're not talking the same policies that were even just 10 years ago. We're talking policies that are new, that are out on the market, that are super beneficial in a lot of different ways.
Within the last 2 years, they've evolved. And I think for good reason, right? Let's think why, right? COVID affected a lot of people negatively. And yes, we don't want to equate death with life insurance, but really, I wish they would rename life insurance to a life benefit, because that's what it really is. If you think about it, if you invest in a good limited pay, policy for your child, whether it be a permanent policy or a variable or a universal policy, depending on the situation, it could provide a tremendous amount of life benefit.
Yeah, because one of the benefits, right, for insurance we've talked about in other sessions is the tax-deferred growth of the cash value.
Yeah.
Right? And so think of any investment growing tax-deferred for a 1 or a 0-year-old, like a newborn.
You can even call it tax-free if you use it correctly. You know?
So you have this benefit of, which people people do not run into a situation where they put money away and they let it grow for 65 years.
Oh, man.
Right? And for a 0-year-old, a newborn, to have money growing for 65 years, no matter where it is going to be very powerful, because by the time they're 65, they can use it for retirement.
Right.
Or for other things that they may want down the road.
In a ton of different manners and respect. But so the episode we call the basics, because we want to make sure people know the basics, right? For example, how much can I do, Mark? How much can I invest into a juvenile policy for my kid? My kid was just born a month ago. I'm limited, right? I can only do like X amount per year, right?
Yeah, so, the way, at least in New York State, and every state's a little different, so let's put that preference in for our listeners out of state. New York State has a different,
a little feng shui,
a little feng shui to it with
shui.
Insurance regulations and requirements and demands and things along that line. So for a juvenile, if they're 4.5 years or under, the parent needs to have 4 times the amount of life insurance coverage on themselves, in order to be able to do the policy.
So that means for death benefit. So if I have $1 million of death benefit, then the most I can do for my 4-year-old is $250,000 of death benefit.
Yep, which
Got it.
doesn't necessarily relate to the premium, but it's the rules and regulations in New York State at this time.
Got it.
If they're over 4.5 years old, then it drops to two times.
Right.
So for that same $1 million of coverage you have on as a parent,
Now
you
I can
do
buy a
$500,000
of
on the child.
death benefit.
Death benefit on the child.
Because the premium is a different story. When I say premium, the amount of money I'm investing is a different story comparative to the actual benefit.
And the one disclosure we should put right out there when we're talking about any type of insurance, the reason you buy life insurance is for the death benefit.
Right.
The premium, the access to cash value, the equity, all the different concepts we're going to talk about are a side benefit to you actually needing the death benefit
if something happens. Right.
Correct.
And that's why I call, I say I wish it was called the life benefit, because at the end of the day, you are investing in someone's future. And even if the future is cut short, there's still something there to protect their legacy.
Yeah.
Right. And a lot of times, that is one comment we get a lot where, well, am I buying this because I think my kid's going to die? No. But the hedge is, what if your kid becomes sick or ill? Yeah. What if they develop some type of kidney or blood issue or liver issue, right? And that's why I think the basics to this is really important, is that not only are you insuring their life, but you're insuring insurability.
Yeah, let's talk about the earliest that you can get insurance on a minor, on a child.
Yep.
Right? Basically, you have to have the Social Security number issued.
Which is by like day 6.
Yeah, give or take.
Day 7.
Right? And you need to have had your first full exam with your pediatrician.
Yep.
Right, so that could be
6 months,
2-3 weeks,
or
a month or two.
How fast do you do it? Yeah,
right, into the life of a child, that you can put insurance on that child.
Yep.
Right, now, why that's important, right? Because there is a subset of the population where after 6 months, 3 months, or even at birth, there are some children that you can't get insurance on because they're born with
heart arrhythmia or something spinal cord related.
But there's also in the insurance world a long list of things that children acquire as they get older, whether it's asthma, whether it's diabetes, things that don't manifest themselves right at birth.
Crohn's disease, something to that effect, right?
Yeah, so some of these factors will deny insurance to that child as they become an adolescent, as they get a family and they have kids. They need insurance at that point, and they may not be able to get it when they go to sign up for it.
This is where I can't wait to go live, because I actually do have a real life scenario, actually 3 in this case, because I've done so many juvenile policies. I have 3 scenarios. One that I remember the most is I was talking to a gentleman, and we wanted to do insurance for him and his wife, and then his children. And I remember him, pushing back pretty hard about the kids because they're healthy and there's nothing wrong with them. And then within 3 months, their child ended up having some type of brain tumor. And it got cured, thank God. But now that for life, the little guy is going to be out of the ability to do that for himself.
Yeah, and listeners need to understand there's something called the MIB. It's not Men in Black. It's the Medical Information Bureau. And when you're signing your release forms, usually from a hospital or doctor or stuff, you're agreeing in those forms that this information can go out there in the Medical Information Bureau.
So it can be accessed by companies to do just this.
Yep, and it may be for legit medical reasons, or it may be for all life insurance companies to access or health insurance companies to access. So when you have those things, it's not like you can hide them, and you don't want to, right? You have to be honest and fair and open on an application.
Because if you're not, it catches up with you.
But early on in life, if you start adding to that list, all of a sudden you start going down that road of being either rated, which is where insurance companies will give you the insurance.
It's $1 per thousand,
but they will charge you 2 or 3 or 4 times per thousand because there's more risks to them. Right. Or you get to that point after you're rated very quickly sometimes where you're uninsurable.
Denied, right.
No matter how much money you're going to give an insurance company, they're going to walk away and say, nope, too much risk for us. We're not going to take your premium. We're not going to give you a death benefit.
Yeah.
Right. And now imagine being a 30-year-old with 3 kids, and you're the major breadwinner, and you need insurance if you died tomorrow, because otherwise your family would be a welfare family.
You can't get anything.
And you can't get it. Right? Well, imagine that 30-year-old had a parent or a grandparent that said, hey, you know what? I'm going to get insurance at his newborn when that person's first born.
Right. And I mean, let's look at the real numbers here, right? So I mean, I'll even use my kids for an example. When my daughter was born, she was about 2 weeks old, I started a policy for her. Right? It was like whatever it was, $67 or $68 a month. And now, perpetually, she'll have almost $350,000 of death benefit forever.
Yep.
No matter what. And then it goes up, because in her case, I did a variable policy because she's younger, so she could take on the risk.
Yep. So, there's different policies without getting too much into
I don't want to go too deep in the woods, but yeah.
Let's talk about the living benefit part of insurance on a child, especially when you overfund them a little bit. When you put more premium into them early on, you have money going into a cash value that in some cases are either tied to the general account of the insurance company or the separate account of the insurance company.
Correct.
So some of them are tied to an interest rate.
And some are tied to the market.
And some of them are tied to a sub-account that's not technically a mutual fund, but looks like a mutual fund.
That acts like the market.
That acts like and you can rebalance, and some companies have 30, 40, 50 different choices that you can invest in, similar to like a 401k
portfolio, right?
Right. They're sub accounts. They allow you to be more growth oriented or more conservative, and you can rebalance. You can restructure.
That's really important. Let's highlight that, because I've talked a lot to clients about buying life insurance for their children, and to them, all they see it is as a death benefit. They don't see it as a place where cash goes to grow, and then where that cash goes to grow is super important. So say what you said again about the difference between a non-variable account, like a general account, and then a variable account, like a separate account.
Yeah, so
a really critical takeaway.
Yeah, so a whole life policy, and they're all classified whole life, but certain policies are interest sensitive,
right,
or interest bearing within the general account of the insurance portfolio.
Okay.
Right. And they get credited interest on your cash value each year. But there is a section, a variable section, and it's called variable because the cash value fluctuates with the market.
And not every policy has that.
Not every policy has that it will allow you to invest the money.
Got it.
In sub-accounts that, like I said, are very similar to mutual funds. They're not the same thing. You can't call them mutual funds.
But
a lot of insurance agents do, and it's wrong.
No, they're sub-accounts.
They're sub-accounts. But those sub-accounts allow you to rebalance.
Yep.
They allow you to go more aggressive or
and then
more conservative.
And then that cash growth does what?
It grows.
A cash growth grows, but what happens to the death benefit now?
Yeah, so most policies that are tied to a variable, not all of them,
not all,
but most policies, the death benefit grows with the cash value.
Right.
So unlike a straight whole life where you buy $100,000 of coverage, you pay into it for 50 years,
right,
you put in $80,000, they pay on $100 when you die. A lot of the variable policies, that death benefit will systematically increase with your cash value.
So I think what we're saying here is that imagine go to the grocery store and there's all the different types of bread, and they're all made a little bit differently. Well, which one do you buy? Well, you buy the one
Seedless rye.
You buy the one that you're most comfortable with, right? But what if I told you if you bought seedless rye, it ends up giving you some type of illness, and that if you bought this one over here, it'd be better for you? It's the same thing for life insurance. That's why you want to work with someone when you're buying life insurance for your kids.
Exactly. So not all policies are created equal.
They're not all created equal. I mean, you look at the 80s and all the policies back in the 80s that were sold were ULs, right? Everyone was selling ULs in the 80s. And now all of a sudden through the 90s and into the 2000s, those ULs, universal lives, started to explode.
Yeah.
Because they weren't done correctly. It was a new product, so they didn't have all the mechanics behind it and understand it.
Yeah.
So now that things have changed and there's more regulations, my point to the basics out here is that as you talk to somebody about this, please don't do the water cooler talk.
Yeah.
Don't do the water cooler talk, man.
Yep. So
it's not worth it.
And the fundamentals of it is the child is the insured. If
Correct.
the child passes away, the death benefit goes then to either the parent.
Right.
Right. And that's important because there could be leading up to the death of a child. A lot of times there's major medical bills.
Huge. I mean, imagine
that insurance doesn't quite cover.
Imagine your kid is sick. They need chemotherapy. They need some type of special treatment, right? And you don't have the cash for that. You got to put in a credit card.
Exactly.
You got to mortgage your house a second time.
Yep.
And then they pass. Well, oh, hey, by the way, here's the $300,000 of death benefit. Now you can go pay off all your bills.
And some parents will assign another child in the household as beneficiary. You just got to be careful with that because if they're a minor, it doesn't go directly to the child.
Probate.
But some parents say, hey, you know what? If I have 3 kids and I have insurance on all 3 of them, and they're all the beneficiaries of the other 2.
That makes sense.
That's future college money for the other 2.
Right, if something happens,
one passes away.
Right?
There's a million uses.
We don't want to be morbid. It's not about that, but it's a redundancy in the portfolio that if a grandparent is out there watching and they say, well, I have $80,000 or $90,000 sitting around in a bank account, I want to put in $50 a month to Johnny, Jill, and Jackie's future, what's the best way to do that?
Yeah, and a lot of times we get asked that by grandparents because
how do I do it?
They don't know whether the kid's going to go to college,
right?
So they kind of shy away maybe from a 529. The passbook savings that they used to do, or the certificates.
There's stuff at different banks that they offer, like the child CD rates, where it's like 1% or 2%.
And where you got to be careful is once you start putting it in the child's name, it had if you go back to our podcast with Dr. Dean Scarless on college planning, it starts affecting them down the road for financial aid.
Buddy, quick math. You put a kid's 0 years old, put $50 a month in their name from 0 to 20 or 0 to 19. How much money is in their name by the time they get to 19 years old, even with 1% interest, right?
Yeah. I mean, with growth, you're going to have astronomical number in there.
And now they got to go do their FAFSA and their Pell.
And they're going to put it right on there.
But
the benefit to the juvie is what? The owner can be either the parent
or the grandparent. But the amount of coverage has to be on the parent, though.
Correct.
Okay.
Correct.
Making sure we got that.
So a lot of times we call them grandparent legacy accounts.
Yep.
It's the grandparent that's doing it on the grandchildren. Because they want to find another place where it's effective for them to save money.
Yeah.
Right. The other great thing about insurances is that they can be signed over to the child later down the road.
Just had that happen. I had a friend call me. His mom signed over their policy to the daughter, and now we get to do other things with it. Yep. To help them and get them in a better situation.
And another reason you need to work with an advisor is because there could be some tax consequences when you do that. So you need to know what the tax consequences are, when to sign it over, how to sign it over, and the benefits of it. But for me, I like that as a parent. I like the fact that my kids do not have access to that cash value until I decide,
hey, I'm going to sign it over,
that they're responsible enough.
Yeah.
Right? Because you may not want to sign that money over to an 18-year-old.
I think about it as a wedding fund. I mean, honestly, for Sammy, for my daughter, I thought about it as a wedding fund, right? When she is old enough to get married, I'm going to be able to take this policy and say, here you go. You can keep your death benefit, and you could take a $30,000 loan from your policy, and then you could pay for your wedding, and you could decide to pay it back, or you can just cash it out.
Yeah, so
that's how I thought about it.
So let's talk about that, right? Right. If you start a policy when a child's 0, 1,
she was
2,
0. I put $67 a month in.
About the age of when most people get married nowadays, in their 30s, right?
25, 30, let's say.
Getting married late. What's going on? If they're
I feel like the new generation of kids is getting married wicked young, by the way.
Yeah, the
new generation of kids they're like out of high school, they're dating, and they're like barely a year into college, and they're married. Yeah. And that's because the dating pool is kind of a SHIT show right now. Don't ask me how I know that. I have buddies that are single, but yes, it's not fun. So kids are getting married earlier and earlier right now.
Yeah, so there's a potential use. If you're not going to use it for the long-term effect of retirement, which you still could, you could use it for wedding, right? You could dip
car
into
purchase.
You could use it for down payment on a first home, right? All these things that are going to come up in life.
But the basics, the critical takeaway though, is that, okay, let's say for my daughter, I put in $30,000, right? Okay. And then she needs money. So if I take a loan out on that $30,000, right, am I going to pay taxes?
Nope.
Right? Because why? I took a loan out on the money. It's my own money.
Yep.
And I give her the money and say, here you go. Here's your 30 grand for your wedding, right? And you can decide to pay it back if you want.
And that's a whenever loan, meaning you're not locked into monthly payments going back in. You just need to pay the interest on the loan.
That's it.
And so next month, if you don't have affordability to pay back the loan, you don't have to.
Name
another loan where that works like that.
Because people got to remember, it's your money. It's yours.
Yep. So let's say 3 months down the road, you want to you got tax return back.
Oh, I got my $6,000.
And you want to put $2,000 back on the loan. You can do that then. If the next month goes by and it's a little tough, you don't have to make a payment then. Right? You just have to keep up with the interest on the loan so that the policy doesn't lapse, right? Yep. Some policies, though, you don't even have to take a loan. You can do partial surrenders
just a partial withdrawal
of that advance and death benefit.
Yep.
Right? So there are some tax efficiencies on both sides, but the benefit to putting it back is now it's back in the pool of money that's going to grow.
Right.
Right? So what's the next event that's going to come up for those kids? They got married, they bought a house, they bought a car, things along that lines, right? Well, it's their kids. Right? It could be the person who's doing it, their grandkids are going to go to college now.
Yeah.
Right? So now there's a pool of money that's grown for 40 years, 50
45
years,
yeah.
tax deferred, that they can now access for college for the grandkids.
Yep.
Right? And if they don't need it there, what's next? Retirement for them. There's your 60 years of growth.
There's a lot of little benefits to having it if you think about it in the big picture. If you think about the long term.
Yeah. Think about it like this. If let's say in the first 10 years you put in $10,000 into a juvie policy, right? $1,000 a year
But again,
for 10 years.
I don't want people to get it twisted. The investment is secondary.
Correct.
Because a lot of times I'll get why am I doing this when I could just invest it into a brokerage account? Well, because there's different purposes. Like the brokerage account is fully taxable. It's a non-retirement account. Every year you're going to get a 1099 for your dividends and your capital gains potentially.
Yep.
You know, and then when you take the money out, depending on what your cost basis is, you're going to have to pay more taxes on it.
Correct. So, but let's look at that. $1,000 a year for the first 10 years.
Sure.
Right? If money doubles every 10 years, the rule of 72 at 7%, money's going to double every 10 years. So from 10 to 20, it's going to be worth $20,000. From 20 to 30, it's going to be worth 40. 40 to 50, it's going to be worth 80. 50 to 60, it's 160, right? 60 to 70, right? 320. 70 to 80, right? 600. So by life expectancy, if you just use the cash value when you're 70 some, you're going to have 300 to maybe $600,000 in there, right? Your death benefit is probably going to be in most policies somewhere around 2 to 3 million at that point.
Right, because if you use the right policy, what happens is it ascends with the cash value.
Yeah, so from a legacy standpoint, the next generation, the grandkids, are going to inherit this massive amount potentially tax-free through life insurance that it's a product that can be moved into a trust.
It's again, the words people hear scare them sometimes. Just like if I were to say to you, hey, I can give you something guaranteed, no downside, no risk, and income forever, what would you do? You would jump up and down and say, great. I'd say it's an annuity. You're like, oh my God, I hate it. No, right? Same thing with life insurance. It's tax deferred. You get a guaranteed tax-free death benefit. It goes to your beneficiary. It's, people get worried because it's a word, and words are sometimes polarized with negative energy because they just don't know enough about it.
Yeah, and the guaranteed word is associated with the paying ability of obviously the insurance company. So, but if you're with a A+ rated company, and
but we all know. But in New York, there's reinsurance too.
Correct.
So if I'm company A and you bought a policy through me and I go out of business, well, guess what? Companies B, C, D, and E all have to suck up the slack.
Yeah, so
for company A.
Yeah, there's a lot of protections within that market, which is great. And then the other main thing too is, let's say, and this is, it sounds kind of funny, but let's say your kid is a derelict and just is like, forget you guys, I'm out of here.
There you go. So they bounce. See you later.
And doesn't want to be part of your family anymore, right? That happens sometimes. Black sheep,
happened
right?
Plenty of times.
They're gone or whatever.
Listen, we see it at least once a year.
If you're still the owner, you have every right to cash that out.
Hey, it's not yours for now. It's mine still because I'm still the owner.
So it goes back into your pool for retirement money. It goes back into your pool of money for non-retirement, whatever it might be.
Not that happens frequently, but it's a system of control because I've seen the other thing happen, Mark, where an 18-year-old comes into $2 million. By the end of the month, there's a Bugatti, there's a jet ski, there's a boat. Are those dollars being spent wisely?
Nope. And then a couple of years later, there's nothing.
Now they're broke, right?
Yeah.
I think it's time for Community Spotlight, buddy.
Yeah, time for Community Spotlight. We got a great one today. Today's is Joseph Jacob Jewelers. They're at 1 Crossgates Mall Road in Albany, New York, 12205. Phone number 518-608-4532. Just great team over there.
Phenomenal place.
One of the managing members over there, Amanda Byers, does a great job. They'll find you what you need.
They got my dad a nice watch for Christmas. I got him a nice Giants watch.
I mean, if you're looking for watches, you're looking for rings, necklaces, bracelets, you name it. I know there's a lot of jewelers out there, but there's not a lot that really specialize in really caring and finding that
customer service, man.
Perfect thing for you. But they're located right in Crossgates Mall, so go check them out. Good company to be part.
They're right across from Starbucks, so they're right in the middle, the center floor, front row. So
yeah,
right
or if you have kids, that's got the jump place.
Billy B's,
on the escalator.
Send your kids upstairs. You stay downstairs.
Yeah,
no shop.
Knows that. So great community spotlight. But the other factor I think we need to talk about is, those are all great things to use the cash value for. But think of it like a home where you're building up equity, right? The equity in the home later down the road. We just talked about insurance being different than what it was 10, 20 years ago.
Sure.
Insurance is going to be different next year, 10 years, 20, 30, 40 years in the future.
It's going to continue to evolve.
What isn't going to change is the fact that you have equity built up in a policy that then you can exchange
for other stuff,
for a new policy that has the bells and whistles that maybe you want down the road, right? If we look at insurance policies that we wrote 20 years ago, 30 years ago for juveniles when we first came in the business,
sure,
they've built
10,
up
10 for me, 20 for you.
they've built up a lot of equity, right?
Yeah.
But at that time, they didn't have on the market the long-term care options as far as riders they have now for life insurance.
Listen, what did New York State just put out about long-term care? They just put out this thing that says if you have a governing body and you have more than 10 employees or whatever the case may be, you have to offer some type of long-term care.
Yeah. So
it's crazy, but you need it.
yeah. So even though those policies didn't exist 10, 15 years ago, because we have equity in those policies now, you can do what's called a 1035 exchange. You can dump in that cash to the new policy.
Taxes?
No taxes on the exchange, no penalty on the exchange. And not only that, but it reduces any future premium because it's as if you added 30, 40, 50,000 to the new policy right away.
So it's like basically owning a home.
So now you're getting the new policy, the new bells and whistles that you want, the riders and stuff like that, at a fraction of the cost it would cost you if you went out there and paid new for it.
Got it.
Right? So by building that equity early on, you're opening yourselves up to take advantage of products that aren't even invented yet.
And it's and in most cases, especially for a juvie, it's between $40 and $80 a month. And you know what? And I don't say that lightly because in the inflationary period we're in, where gas prices are high and food prices are high, egg prices are high, right? $40 to $80 may break the bank for some people. Okay, yeah. But it's a question of habit, and I'm never a person that's going to focus back on habit. If you like to go to Starbucks and spend $6 a day at Starbucks, how much is that a month? Right? Yeah. Well, $30 a week, right? That's $180 a month. Whereas you go to Cumbies, how much is a coffee there?
99 cents.
Okay,
any size.
Right. I'm just saying. What's that a week? That's $5 a week.
There's your premium.
So there's 25 off of 180. I just saved what? I just saved $120 plus that I can go do something else with. So it always comes back to habits. But you know what? As I've been working with people for the last 10 years, I try not to harp on that because people have their little pleasures. Yep. And you should enjoy your little pleasures, okay? But when it comes to the point of you hamstringing yourself or your kids from a really bright future, maybe you need to downgrade those little pleasures into something else, you know?
Yeah, I mean, it's a minor sacrifice for a major gain.
I just found $120 for everybody, right? Not that I don't love Dunkin' and Starbucks, but I swear to God, it was about 6 months ago when inflation just started to go up. My son wanted some donuts, so I stopped at Dunkin'. I said I had 10 donuts and a coffee, and they're like, oh, okay, $9. I'm like, whoa, $9, little munchkins, you know? I'm like, all right, we're never going back there. I'm going to make them at home. It's crazy. So
I can't picture you inhaling a munchkin.
No, they're going, right? So even the regular size donuts, they look like munchkins, right? I always like Krispy Kremes. You go and they give you the free donut when you get there. It's really good.
The other thing too that's nice about juvenile policies is a lot of policies you can customize the payment period.
Yes.
So we're not talking on paying on policies for, even though you can pay them for whole life.
You can
continue to pay them forever. There are policies specifically designed that are limited pay.
Right.
You can pay 7 years, 10 years, 12 years, 15 years, again, 20 years, depending on the company and the policy.
It's how you design it. And again, I don't want to go too deep in the weeds, but what is a MEC, right? And what happens to an insurance contract if you don't fund it correctly? That's where you work with the right professional. They're going to ask for a no lapse. They're going to ask for a non-MEC. Right, they're going to ask MEC's a modified endowment contract, where if you underfund or overfund a policy for a period of time,
it loses the benefit of life insurance.
It loses the benefit of life insurance and now acts like an investment, so it's all taxable.
Yeah, so you got to be careful with it.
That when I run a juvie for somebody, my first 3 words are no lapse, non-MEC, non-med. Right, I don't want anyone to have to worry about health, which they don't in New York under 14 and a half.
But being
no
able
medical.
to control that premium period is very important, because there's a lot of listeners out there right now that might be grandparents and saying, you know what, I wish I had done this when my kids were 0, 1, or 2, but my kids are 15. You know what? It still makes sense.
Do a 15 pay. Do a 15 pay. Then it's done by their 30.
Yeah. So there's a lot of flexibility. There's a lot of advantage in it, and as with anything, diversification. It should be done with the context of looking at your other investments, what else you have going on for the grandkids or your kids, and your own personal portfolio.
One thing someone got to, which was really great, I don't want to run too long here, but like, let's say you did a life insurance policy for your kid, and then your parents came to you and said, hey, we have $10,000 for little Samantha, right? Well, you could take a portion of that and dump it in. You're not relegated to making a guaranteed payment. I mean, you probably continue to make the payment, but you can dump in and put extra in if you want. rather than have it sitting in a bank account making next to nothing.
Yep.
Just food for thought.
Yeah, and that benefit of cash value down the road, you can't understate it enough. There's so many different choices. I was just coming up one in my head where I've had some clients that their parents started, a juvie policy.
Right.
And the kid gets into 20, 25 years old, and there's
Right.
equity in there, and they're having trouble because the student loans are starting to come due.
Yeah.
And they have a car payment. And we've dipped into the cash value to pay the car off. And the car payment was $400 a month. And the car payment's now gone, and they lowered their payment to make a not a mandatory, but a voluntary $200 a month payment back to the insurance.
Back to the insurance company. Yeah.
So they took a $400 loan, that was sucking $400 cash value out of their household.
Sure.
And they just lowered it to $200 by choice. And
Makes
now
a
that
lot of
extra
sense.
$200 helps them pay their college loan.
But those little wins right there, at the critical time, they are the best relationship builders, because you now are able to help someone through a really hard time in their life. And then 3 or 4 years from there, you look back and you go, wow, I remember how bad it was. Now it's a lot better. So let's do the next thing, right?
Yep.
So
our
what a great episode.
Yeah,
Wow.
our listeners
that was
need
awesome.
to reach out to us. We can walk you through the ins and outs of it. But
Yeah.
ultimately, you can find the SC Group at 43 British American Boulevard in Latham, New York.
Always here.
800-222-3202. You can find us at yourtimeyourmoney.net, and that's for your net worth. Please like and subscribe. Most important, like, subscribe, and share. It allows us to get our content out there, and keep sending in those requests for different topics you want us to cover as well.
We hope that we can get to a live show sooner than later. It's coming. We're going to do a live show at some point. We're just working through the nuances of what it looks like with all the regulations.
And we're excited. We're in the process of branding out another branch of our practice.
It's coming.
We're going to do a launch and an episode dedicated to that as well. So I know you're excited about that. So
it's coming. We're gonna unveil it. We're gonna slowly just sneak little things in
the big
there.
unveil. But as always, it's your time
And your money.